Have you ever sat in front of a blinking price board, green, red, flashing, your heartbeat a little faster than normal, your thumb scrolling without stopping, and in one brutally honest moment you ask yourself, am I investing to build wealth? Or am I trading to escape the helplessness I feel in the rest of my life? Quiet wealth welcomes you. If you're a business owner, a working professional building savings, or an investor who wants a strong mental framework, a system that doesn't collapse when the market changes mood, this channel was made for you. If you'd like more conversations like this, free and consistent, consider subscribing and turning on notifications. And to everyone who supports this video, I'm genuinely wishing you freedom, financial freedom. Yes, but also the quieter kind, freedom in your mind. Let me start with a painful truth. Most people don't lose because they lack information. They lose because they carry too much illusion. They believe that if they can just find the right ticker, the right news, the right group chat, the right guide, money will flow into their account. When the market rallies, that illusion grows. When the market turns, it doesn't die, it changes shape into excuses. It was manipulation. It was bad news. It was the times. I was unlucky. And the loop repeats, year after year. Here's what I want you to hear clearly. I learned a set of principles from Charlie Munger that feel almost cold. Not the kind that makes you excited today, but the kind that keeps you alive long enough to build durable wealth. No sugarcoating, no promises, just one question, again and again. How do we avoid the dumbest, longest, most expensive mistakes? Because markets don't reward good speeches. Markets reward the person who stays rational while everyone else is losing their mind. The first principle sounds simple, but it's brutal in practice. Success isn't complicated. It's hard. Hard because it asks you to do boring things for a long time. Hard because it forces you to say no to shiny distractions. Hard because it makes you accept that big money often comes from refusing to act impulsively. Look around. Many people trade like they're running from silence. Sitting still makes them anxious. Staying on the sidelines makes them fear missing out. Having no open position makes them feel useless. So they scroll prices the way they scroll social media. What's going up becomes desire. What's going down becomes anger. What's going sideways becomes boredom. That isn't investing. That's stimulus addiction. Munger had a mindset that sounds backwards to the crowd. The big money isn't in buying or selling. The big money is in waiting. And that simplicity hurts egos. The ego wants to prove it's smart. The ego wants to brag about catching bottoms and selling tops. The ego wants the thrill of, I get the market. But the market doesn't care. It punishes impatience and rewards the person who can tolerate boredom without self-destructing. I've seen brilliant people, sharp, articulate, confident, watch their accounts slowly shrink. And I've seen ordinary people who don't talk much, don't show off, don't chase rumors. They do a few things right, consistently, and over time their wealth grows. The difference is rarely IQ. The difference is discipline of thought and discipline of emotion. There will always be phases of collective excitement and phases of collective panic. In excitement, people tell stories. In panic, people hunt for someone to blame. A mature investor does something else. They look at probabilities. They look at risk. They ask, how wrong can I be? More than, how right could I be? Most losses don't come from choosing the wrong stock once. Most losses come from stepping into situations you should have avoided. Munger's idea is simple. We didn't get rich by being right all the time. We got rich by avoiding big mistakes. Avoiding a catastrophic loss is already half the battle. Not losing money is a skill. And it's rarer than people think. In our market, danger often wears a beautiful mask. A stock rising on nothing but a story. A rumor packaged as certainty. Leverage used because someone else is bragging about fast profits. Buying because, there's a big move coming soon. That word, soon, is a trap. It turns you into a waiter. Not an analyst. It turns you into a gambler on events. not a builder of value. Munger preferred what is boring, clear, and repeatable. Good businesses that are easy to understand, with durable advantages, run by capable and ethical people, bought at a reasonable price, then held for a long time. Yes, holding is hard in a volatile market, but hard doesn't mean impossible. It means your standards must rise. You don't hold everything, you hold what is truly worth holding. Now let's talk about compounding. Because people romanticize it, compounding doesn't reward the impatient. Compounding rewards endurance. It doesn't just happen because you opened a brokerage account. It happens only when you don't break the process. You break compounding by trading too often, by jumping to a new opportunity every week, by using leverage that forces you to sell at the worst time, by making one good profit, then getting overconfident, then betting bigger, by quitting right before the process starts to pay. Think of compounding like planting a tree. You water it today, you don't see fruit tomorrow. Most people want fruit tomorrow. So they keep changing seeds, switching pots, breaking branches to check if it's growing. Then they conclude, this doesn't work. The tree wasn't wrong, the gardener was. Social media makes this worse. It shows highlights, one winning trade, one lucky month, one explosive screenshot. It rarely shows the margin call, the months of grind, the years of progress given back in one greedy decision. People share victories, not accidents, and newcomers confuse a highlight reel for a reliable method. If you want a realistic advantage, extend your time horizon. If you think 5 years is enough, think 15. If you think 10 years makes you good, think 20. A longer horizon doesn't make you slower. It makes you harder to shake. Another principle sounds almost too simple. Wealth isn't only about earning more. Wealth is also about needing less. Many people earn well but spend like they're trying to prove something. That kind of success is fragile. It makes you dependent on cash flow, on approval, on image. Dependence is expensive because it pushes you into rushed decisions. Living below your means gives you breathing room. Breathing room is power. It means you're not forced to sell when the market is ugly. It means you can act when others must retreat. It means you can sleep. And sleep is a return many investors forget to count. Now let's go deeper. Because the market is not only numbers, it's psychology. Most bad decisions are not caused by a spreadsheet. They're caused by emotion, FOMO, envy, fear of being left behind, the urge to make it back, the refusal to admit a mistake. Ego is the investor's most dangerous enemy. It makes you hold losers to prove you were right. It makes you average down to avoid pain. It makes you search for comforting news instead of uncomfortable facts. It makes you blame the world instead of reviewing your process. In the end, ego kills accounts more often than markets do. What helped Munger, and can help you, is treating mistakes as tuition, not humiliation. Tuition is valuable only if you extract the lesson. Otherwise, it's just a stupid fee. So build a small habit. After every buy or sell, write a short note. Why you entered. What would make you exit? What would prove you wrong? No fancy writing, just truth. If you do this for a year, you'll see patterns you can actually fix. Another underrated advantage. Simple beats complex. Complex strategies can look impressive, but they often break under real human pressure. Humans panic. Humans rationalize. Humans get greedy at the worst times. The more complicated your system, the more points it has to fail. Choose simple and robust. Simple enough to follow when you're tired. Robust enough to survive noise. And here's a principle that sounds boring but changes everything. Investing is the art of ignoring. Every day brings endless news. Endless tickers. Endless, perfect setups. But your attention is limited. Every yes costs you focus. Many opportunities are just distractions designed to keep you busy, not wealthy. Also, avoid environments that make you irrational. Your environment is not only where you live, It's the information stream you consume. If you spend your days inside groups that only shout buy and sell, that only brag, that only provoke, you will slowly lose your own rhythm. You'll think you're learning, but you're being pulled. Markets don't require you to be loud. They require you to be steady. Before any decision, I use 3 questions. Do I truly understand what I'm buying? If I'm wrong, how much can I lose, and can I live with it? And what emotion is pushing me right now? FOMO, revenge, or the need to prove something? Ask these 3 questions and you'll avoid more damage than most advanced indicators ever will. Now I want to ask something practical. If the market closed tomorrow for a year, what would you have left? Skills, income sources, health, relationships, purpose. This is why the best investment is often investment in your own ability to produce value. Markets allocate capital, but your greatest capital is you. When you upgrade that, you fear cycles less. And please remember this: you don't need to win every day. You need to stay in the game for a long time. Durable wealth is built from consistency, fewer decisions, higher quality decisions, repeated with discipline. One final distinction that saves many accounts: a plan versus hope. A plan is written. It has conditions, scenarios, risk limits, and responses. Hope is a feeling you get when you see a big green candle and whisper, "This time it will work." Hope isn't evil, but hope isn't a strategy. So start in the most unglamorous way possible. Stop doing the things that reliably punish you. Reduce meaningless trades. Stop buying because of hype. Stop using leverage because of envy. Stop trading when you're angry. Stop treating the market like a casino. Build a simple plan. Track your decisions. Protect your sleep. Protect your health. Keep learning. Then wait. Patience isn't staring at the price board and suffering. Patience is preparing, then acting only when the odds and the risk make sense. Patience is holding quality through noise. Patience is accepting that sometimes nothing dramatic happens for a long time. And that's okay. Let me add one more layer that Munger cared about deeply: integrity. You can build trust for decades and lose it in a single afternoon. In markets, integrity is not about sounding smart. It's about being consistent between your words and your actions. It's about not pretending certainty when you don't have it. It's about not pushing other people into risks you wouldn't take yourself. It's about admitting, "I don't know," without feeling ashamed. The market is an excellent teacher of humility, but only if you cooperate with it. That's why I get nervous when I see the market treated like a stage. Everyone wants to be an expert. Everyone wants a crowd. Everyone wants applause. But applause doesn't pay your drawdowns. A viral prediction doesn't save you from a forced liquidation. And a confident voice doesn't change the math of risk. The safest investors I know are not the loudest. They are the ones who can sit quietly with uncertainty, adjust when evidence changes, and protect capital as if it is oxygen. And while we're here, let's talk about a mistake many people make when they learn a few principles. They turn them into slogans instead of practice. They say, "Be patient," but they check prices every 3 minutes. They say, "Risk management," but they size positions based on excitement. They say, "Long term," but they panic after a red week. Real discipline is not what you say. It's what you do when nobody is watching, when the market is boring, and when the market is terrifying. Here's a helpful distinction Munger hinted at in different ways: mistakes of action versus mistakes of omission. Sometimes the most painful regret is missing a rare, obvious opportunity. But for most people, the more dangerous regret is a decision made in emotion, because it can destroy you fast. Missing an opportunity is frustrating. But another opportunity will come if you stay solvent and stay calm. Making a reckless move can remove you from the game entirely. And if you're out of the game, it doesn't matter how right you would have been later. So when you feel FOMO, slow down and ask, is this a rare, clear opportunity? Or is this just my nervous system reacting to other people's excitement? Because FOMO feels like urgency. But urgency is usually expensive. Opportunity does not require panic. Real opportunity can handle a calm mind, a written plan, and a measured position size. Preparation is the quiet superpower. Build a watch list of businesses or assets you can actually explain in simple words. Learn how they earn money. Learn what could break them. Define the price range where the risk makes sense. Define the conditions that would make you sell, even if it hurts. Do that work before the crowd arrives. Then when the crowd shows up, you are not hypnotized, you are simply ready. And please don't ignore your life outside the charts. Munger talked about this more as he aged. And it matters more than most people admit. Wealth is supposed to buy you a better life, not a narrower life. If investing is ruining your sleep, turning you into an anxious person, making you snap at your family, stealing your attention from your work, then your strategy is too costly. There is no portfolio return that can buy back time with the people you love, or repair health you neglected for years. Health is not a side quest. Health is the account that lets every other account matter. If you want a long investing career, you need a long, healthy life. That means you don't treat exhaustion as a badge. You don't treat constant stress as the price of ambition. You don't stay up every night staring at candles like they owe you an answer. The market will be there tomorrow. Your nervous system might not be, if you abuse it long enough. And relationships, this is not sentimental talk. It's reality. The quality of your relationships is the quality of your life. If you reach a net worth number but lose your peace, your family, your friendships, your ability to enjoy a simple meal, then you didn't win. You traded a life for a screenshot. Munger's later reflections remind us that the point is not to win a scoreboard. The point is to build a life that feels stable, meaningful, and free. Let's also talk about needing less in a practical way. When your lifestyle is inflated, you become fragile. You need the market to cooperate. You need income to be perfect. You need your image to be maintained. That fragility can force you into decisions you would never make if you had breathing room. But when you live below your means, you gain a kind of quiet power, the power to wait, the power to say no, the power to take a short-term hit without breaking. Sometimes people ask, what's the fastest way to improve? And the honest answer is, remove the obvious mistakes first. The fastest progress often comes from subtraction, not addition. Subtract leverage you don't understand. Subtract positions you can't explain. Subtract information sources that agitate you. Subtract late-night chart watching that makes you impulsive. Subtract the need to be right in public. When you remove enough noise, your decision-making improves almost automatically. And one last thought in Munger's spirit. The best investors aren't addicted to activity. They're addicted to clarity. They wait until something is simple enough that they can explain it, size it, and sleep with it. They don't need to predict every wiggle. They don't need to participate in every trend. They treat capital preservation as the first job and growth as the second job. And over time, that order of priorities creates a life that is both richer and calmer. Now I'll end with a question I want you to answer privately. If the next 12 months look exactly like the last 12 months, same habits, same decisions, same emotions, will your life go up or down? Will you be closer to freedom or farther? Will you be calmer or more exhausted? If that question makes you uncomfortable, good. Discomfort can be the first sign you've met the truth. And when you meet the truth, you can change. You don't need to become a genius. You need to become a person with principles. To keep this video clean and monetization safe, this is educational content about mindset, discipline, and risk awareness, inspired by Charlie Munger and common investor behavior. It is not personalized financial advice, and it is not a recommendation to buy or sell any specific security. If you apply anything, apply it thoughtfully and in a way that fits your own situation. If this video helped you, please hit like, subscribe to Quiet Wealth, turn on notifications, and share it with one person who feels tired and overwhelmed by the market. I sincerely wish you the freedom you want, not only financial freedom, but freedom in your head, freedom from fear, freedom from FOMO, and freedom from ego. See you in the next video. We'll build a simple, opportunity filter, in Munger's spirit, so you know when to stay out, when to step in, and when to do the hardest thing of all. Keep your hands calm. Keep it simple. Keep it sane. Keep going.